Hello, welcome back. We've just been looking at the non-current assets introduction, and in the last session what we saw was how we record the asset cost initially. So we said we had that idea of capital expenditure, and with that capital expenditure we recorded the cost through the journal entry of debiting the asset cost account and then crediting bank or cash. Now, that's the initial recognition of the asset value. Now we've got to think about the life of the asset. The asset is going to continue in use for several years within the business, so remember, more than one accounting period. So how do we value the non-current asset each year after we recorded the initial cost? Well, what we need to think about now is this idea of depreciation. Now, depreciation is the charge to the statement of comprehensive income to reflect the consumption of the asset in the period. Now, essentially, this is a means of spreading the cost of the asset over its useful economic life. So, let's say we buy a machine and we expect that that machine will last for 10 years. We're going to spread the cost of that machine over a 10-year period. Essentially what we're doing is reflecting the usage of the asset. For example, if I buy a machine and I use that machine to print t-shirts, and those t-shirts I keep in inventory and then I sell them to a customer to generate me income, what I've got to be aware of is the value of that machine at the year end won't necessarily be the same value as when we initially acquired it several years ago. What we're doing is essentially accounting for the usage or the wear and tear of that asset over its life, and essentially decreasing the asset's value over its life, depreciation. Now, the good thing about depreciation is it's consistent with the accruals concept. Okay. What we're doing is recognising the cost of using that asset through depreciation and matching it against the income earned from using that asset. So I'm matching the cost, the depreciation of that t-shirt printing machine against the income that I've earned in that accounting period from using that machine. So the selling of those t-shirts that I printed using my printing machine. So the revenue is matched against the cost of using that machine, the consumption of that machine, the depreciation. So it is consistent with that accruals concept that we've talked about several times now already. A lot of it is to do with that idea of matching the income earned against the costs incurred. Now, when we think about depreciation, obviously we've got to think about, well, how are we going to calculate this charge to the statement of comprehensive income? But also we need to think about how we're going to record that value in our financial statements. For that, we're going to need to do a journal entry. So, accounting for depreciation. Well, there's two sides, obviously, to this journal entry. When we think about the debit entry, as I've already mentioned, depreciation is an expense. Okay, it's the cost of consuming that asset in the period or using it. Remember, we're matching that expense against the revenue earned from using that asset. So what we're going to do is open up a new account, and we're going to call it the depreciation expense account, and we're going to debit depreciation expense, therefore reducing profits in my statement of comprehensive income. So, by debiting depreciation expense, we are increasing an expense account in the period. Our credit entry then, well, remember, depreciation is showing the reduction in the asset's value in its life. As a result then, the credit entry will be to the asset in the statement of financial position. Now we're going to credit a new account called the accumulated depreciation account. Now, accumulated depreciation account is a funny account, okay? It is not a liability. In essence, we don't owe anything to anyone. So what I like to think of it as is a reduction in the asset value. So credit an account called accumulated depreciation, and what that is going to do is reduce your asset cost in the statement of financial position. Now, where we said in the last session that for every different type of asset, motor vehicles, land and buildings, machinery, etc., they all had a cost account. Well, each individual class or type of asset, non-current asset, will have its own accumulated depreciation account. So, for example, you would have machinery cost account, and then also we will have a machinery accumulated depreciation account. And that would be illustrated by the credit entry there. Now, whilst I'm here, let me just mention that all tangible non-current assets should be depreciated with the exception of land, because land is seen to appreciate and go up in value rather than to depreciate. So to depreciate land wouldn't really give a good, faithful representation of the business values at the statement of financial position date. So everything's depreciable with the exception of land. Now, let's see how the non-current asset cost account and the accumulated depreciation account look and are presented in the statement of financial position. Okay, so can you all see there we've got a statement of financial position extract. And remember, we said it has 3 columns in the statement of financial position with 3 headings that relate solely to non-current assets. So you can see then that non-current assets that we have: property, plant and machinery, and motor vehicles. 3 separate class of non-current assets. And we have those 3 columns: the cost, the accumulated depreciation, and also the assets carrying value. Now, an asset's carrying value or book value is determined by taking the cost of the asset minus its accumulated depreciation to date. Okay, so cost minus accumulated depreciation will give you the asset's carrying value or net book value. So we can see then that the cost of the asset is listed out first. Remember, the non-current asset cost account, the T account, is separate to depreciation. So the non-current asset cost is 150,000. Then we have accumulated depreciation. Now remember, the non-current asset cost account is all debit balances because we're increasing that account. We just said that the accumulated depreciation account reduces those asset cost values. So all those credit balances on accumulated depreciation will be minused for each different class of asset. So property, plant and machinery and motor vehicles will have their own separate accumulated depreciation ledger account, and those credit balances would be netted off against the debit of the non-current asset cost to then equal the asset book value, the value that we want to see in our SFP at the year end. And what we do is we sum up all those asset carrying values, and then the total we take in the total column, and we'd add that to our current assets, etc. So that's ultimately what we've got to account for and record. So we've seen how we record depreciation in the books. Now we've got to see the methods of estimating that depreciation charge each year. So first of all, then, we're going to have a look at the different methods of depreciation. Now, in this syllabus, there's 2 main methods of depreciating your non-current assets: straight line method and reducing balance method. we're going to see the first method, straight line, in this session, and then we'll have a look at reducing balance in the next session. So, let's proceed. I'm going to start off with straight line. Now, straight line depreciation assumes that the same charge of depreciation will be charged in each year's financial statements over the life of the asset. So straight line depreciation method is used for assets which are presumed to depreciate evenly over their useful economic lives. So the same charge of depreciation each year over the life of the asset. So we most commonly use this method for buildings. Okay, so buildings, normally we use straight line depreciation. We assume that the same charge is going to our financial statements each year, straight line. Now, when we think about calculating straight line depreciation, you must learn this formula. Okay, very, very important. So, our depreciation per annum then. Well, the first thing we do is start off with the original cost of the asset that has been capitalised. We're then going to minus from that the estimated residual value of that asset. So how much do we think we're going to be able to recover from that asset at the end of its useful life? So, if I've got a machine that has a life of 10 years, how much residual value do I think the asset will have at the end of its life? So how much could I sell that asset for? Or how much could I scrap it for? Maybe I've bought it for £50,000 as the original cost, but then its residual value may only be £5,000, let's say. That's how much I could sell or scrap that machine for after those 10 years. That's its residual value. And that's minused from the original cost. So, the original cost minus the estimated residual value, we will then divide that by the estimated useful life of the asset. So, how long we think we're going to keep that asset for, and how long that asset will continue to generate us future economic benefits. So, cost minus residual value divided by its useful economic life is going to give you the depreciation charge per annum. Okay? And that would be the same charge to your financial statements, same journal entry for the same figure for each year of the asset's useful life. You've got to learn that. It's really important. Now, the alternative way that straight line method could be expressed and what the examiner could ultimately test is straight line based on a percentage. So, the depreciation per annum would be a percentage based on, let's say, the original cost. Now, the examiner will always give you the percentage to apply. So the examiner could say the depreciation charge is 2% per annum straight line, and that would be on cost. All right? And if you think about it, 2% would represent effectively a 50-year life of the asset. Same charge based on the cost each year. So, you've got to learn the first method, and remember that straight line can also be expressed as a percentage of the original cost of the asset, and that would give you the depreciation charge per annum. So, let's have a look at an example then of how we can calculate this and how it would work. So, our example then. We've got Mr. Bubble, who purchased a building on the 31st of July 2005 for $150,000. The building has an expected useful life of 5 years and a residual value of $20,000. It says calculate the depreciation charges for each of the 5 years ended the 31st of December on the basis that it is Mr. Bubble's policy to depreciate on a straight line basis with a full year's charge made in the year of acquisition and none in the year of disposal. And then the second point, it's Mr. Bubble's policy to depreciate on a straight line basis with proportionate depreciation in the year of purchase. So, what we're distinguishing between here is the first requirement is to calculate straight line depreciation of that building. So the first requirement says that we're assuming that regardless of when we acquire the asset, we're going to charge a full year's worth of depreciation, straight line method, in the year of purchase. And the second requirement says that depending on the date that we acquired the asset, we're going to have a proportionate charge of depreciation for the number of months we've held that asset for. So, thinking about this then, we know that we've got a building worth $150,000 cost. We know it has a residual value of $20,000, and we know it has a useful life of 5 years. And what we also know is the year ended the 31st of December. And we want to account for the depreciation for each of those 5 years of ownership of that asset. So using this data then, let's proceed to have a go at this question. Now, as you can see, I've done a piece of paper and divided it into two for the first requirement and the second requirement. I'm going to start with the first requirement first, and we're going to calculate the depreciation charge with a full year's worth of depreciation in the year of acquisition. So, straight line depreciation then is going to be our cost of our asset, which is $150,000, minus the residual value of $20,000, and divide that by the useful economic life of the asset, which was 5 years. Okay, so let's run that through our calculators. So that should give us then a depreciation charge of $26,000 per annum. Okay, and that would be our depreciation charge for that year. Thinking about the full year charge first, let's see how the asset values would deteriorate over the 5-year period. So, we know that we acquired the building on the 31st of July 2005, and that would be the date that we record the original cost of that asset. So, on the 31st of July 2005, we're going to start off the original cost of the asset of $150,000. And what we would do there is debit our building's asset cost account, okay, and recognise that asset cost. Now, at each year end, we're going to do an adjustment to our accounts for the depreciation. For that then, what we're going to say is at the 31st of December 2005, the first accounting year end, we're going to charge depreciation. And when I write out depreciation, I'm just going to do DEP N, just for short, because depreciation is a long word. And we're going to reduce that asset value by $26,000. So, that's going to be a full year's charge in the year of acquisition, even though we acquired the building halfway through the year. So, or just over halfway through the year, should I say. So then, at the 31st December 2005, the carrying value of the asset, or CV for short, will be the cost minus accumulated depreciation to date. So 150 minus 26 is going to give us 124 as our carrying value at that first year end date. Now we're going to see the journal postings of this shortly, but for now that's what we're going to do there. Now we've got to do this for 5 years, so let's proceed to do this for the remainder of the life of the building. Now remember, straight line, same charge each year. So at the next year end, 2006, we're going to have the same depreciation charge for that asset of 26,000, which is going to give us the carrying value at that date of 98,000. And that would be the asset's carrying value or book value that would be shown in the year-end statement of financial position of Mr. Bubble. Okay, so you can see then the asset value is gradually deteriorating the longer we hold that asset. So each year in our books, the asset values would ultimately keep reducing. Let's carry on then. 31st of December 07. We're going to do a depreciation adjustment then at the year end of 26,000, which means our carrying value at that date, minusing the accumulated depreciation, is going to give us $72,000. All right, let's finish this off then. So, 31st of December 08, our depreciation, 26,000, is going to reduce the asset value. 72 minus 26 is going to give us 46,000 as our carrying value at the 31st of December 2008. And then finally, we're going to do this for 2009. Okay, so this would be our 5th year. At the year-end date, we're going to charge straight line depreciation, same charge each year, of 26,000. And at that year-end date, that is going to give us a carrying value of $20,000. Notice then that the carrying value at the year end is the same as the residual value at the end of those 5 years. Which means then when we do ultimately dispose and sell of that building, we can compare it to its residual value and then establish whether we made a gain or a loss. But that's for later sessions. Now, straight line, same charge each year. Now what we've got to do is do the journal postings. So, going back to the start, first thing we're going to do is record the original cost of the asset, of that $150,000. To do that, we need to open up a non-current asset cost account. So, as you can see, I've drew up some ledger accounts already, but just draw some T's with a ruler in your notes, debit on the left, credit on the right. And you can, by all means, pause the recording whilst you do that. In the meantime, though, we're going to write up our first account, known as the building's cost account. Now remember, this is an asset account, which would go into your Statement of Financial Position, or SFP. Now to record that asset at its initial cost, we need to debit the asset cost account. So, on the 31st of July 05, the date we acquired the building, let's assume we paid it with cash, so bank would be the name of the corresponding entry, $150,000. Now, what's going to happen then is obviously we'd credit the bank account, which I'm not going to draw up because we know what a bank account looks like by now. Remember, we're just focusing on non-current assets. So, debit's done, we'd assume the credit's gone away somewhere. Now what we need to do is record the depreciation each year. So, At the 31st of December 05, we had a depreciation charge of $26,000. Look back in your notes. Do you remember the double entry? We're going to debit the depreciation expense account and credit the accumulated depreciation account. And that's what we're going to do each year end when we charge depreciation. So, we now need to open up another account, make this one fairly big, and we're going to call this Buildings Accumulated Depreciation Account. And remember, the accumulated depreciation column is in the SFP. So again, that is an SFP account. And we said we were going to debit depreciation expense. The credit will go to accumulated depreciation. So, at the first year end, the 31st of December 05, our opposite account will be the depreciation expense account for 2005 with the amount of $26,000. That would be the credit entry of the journal for depreciation posted. Now, let's do the debit entry. And again, we're going to have to open up a new account. And this time we're going to call it the depreciation expense account. And depreciation expense goes into the statement of comprehensive income because it's going to reduce your profits in the year. Now, we've done the credit. The debit is going to be posted to this account, 31st of December 05. The opposite name of the account is accumulated depreciation. Just shorten that terminology. 26,000. There we go. Now, we've done the original cost. We've accounted for the depreciation. Now we need to close off our ledger accounts at the year end. Now let's start with the depreciation expense account. Now the whole idea with any expenses or income is that you're showing expenses or income for one accounting period. So let's say for a year. Remember, it's a moving picture recording all your income and expenses in the year. Now when you get to the end of your year, you want to find out the total of your income accounts and your expense accounts like depreciation expense. We want to close these accounts so then we can start afresh at the start of the next accounting period, and then we can start the whole process again, recording a moving picture of income and expenses in the year. So as a result, we don't want to bring forward or open and have a balance at the start of the next year. Or else essentially you're double accounting, because in next year's accounts what you would have is this year's expense plus the current year's expense. You don't want 2 years' worth, you only want 1 year for a moving picture. So any income or expense account from now on, we always write off and clean out at the end of each year. No carried forward, no brought forward. So, we know that we have a debit balance sat on the depreciation expense account. Now, what we need to do in order to be able to post to our financial statements is we need to do a balancing figure, which clearly is on the credit side. But we're not going to call this closing balance carried forward because we're not going to open it up into next year. We're writing off these accounts now, any income or expense account. So what we're going to do is write this off as our expense for the year to the statement of comprehensive income. So the balancing figure will be our expense for the year to the statement of comprehensive income. which is clearly 26,000. And we're going to double underline that account, okay, because that's the total, and that's it, we're going to leave it. Because what we're going to do is debit our statement of comprehensive income to reduce down the profit. That would be the corresponding entry. But notice no opening balance there, okay? We just leave it. So then when we depreciate next year, it's a fresh expense for that year, and it's only that that's going to be shown in next year's statement of comprehensive income. Anyway, moving on. Going back then to our cost account for buildings, well, we can see that the total is on the debit side of 150. With assets, liabilities and capital, it's everything at a moment in time. So it's not going to be treated the same when we balance it like an income or expense. You're not going to write them off because assets, they're going to keep going until you dispose of them. Okay, so just because the building's cost account is an asset doesn't mean you treat it like an income and expense and write it off. You're going to close it and open it because at the start of next year you will have a building there as an asset. So what we're going to adopt here is a traditional carry forward and bring forward as normal. So at the 31st of December 05, balance carried forward 150 as an asset, and then on the 1st of January 06, we're going to have a balance brought forward of 150. So any statement of financial position accounts, carry forward, bring forward, any statement of comprehensive income account, income or expenses, you wipe clean at the end of each year. Okay, and don't carry forward or bring forward. Finally then, let's do the same for accumulated depreciation. Again, this is an SFP account, so you carry forward and bring forward. The clue is in the name, it's accumulating depreciation. So, 31st of December 05, balance carried forward is 26,000. No need to do a total because there's only one figure in that account. And then we're going to open that up onto the credit side, 1st of January 06. Balance brought forward 26,000. And there you have it. That's how you would post from your workings into your ledger accounts. Now, let's just do one more just to make sure we're happy with the double entry. So, in the next year, we depreciated again with $26,000. That $26,000 we're going to do the double entry posting. So, in the next year, we're going to credit the accumulated depreciation account as our depreciation expense for the year. And that's going to get added to the brought forward balance or opening balance. I'm then going to take the debit entry to the depreciation expense account, 31st of December 06, accumulated depreciation for that year of 26,000. That would be your postings for 2006. With no change to the cost account, that would still be 150 for every year until we dispose of the asset. So writing this off then, because it's an expense, for the year ended December 06, our expense to the statement of comprehensive income for the year will be $26,000, and we'd write that off, cleared out again. So we're not showing a total expense, everything for the last 2 years. We're showing it for 1 year. Now let's have a look at accumulated depreciation. We can see that our closing balance again will be on the debit side. And the balancing figure this time would be 52,000. Opening balance plus the charge for the year. So we are going to need to do a total for this one. And then at the start of January 07, we are going to have a balance brought forward of 52,000. So at that date then, cost minus accumulated depreciation, that's going to give you your carrying value that we already worked out of 98,000 that we saw in our workings. Right, now we've done our posting for the 2006 depreciation journal. Now let's balance these accounts off. So, looking at the depreciation expense account, remember we're wiping it clean at the end of each year so we can see the true expense for 1 year, which is just the 26,000. So, 31st of December 06, expense for the year to the statement of comprehensive income will be 26,000, and then double underline that to write it off. And remember, that's going to get written off to your statement of comprehensive income to reduce your profit in 2006. Now, let's have a look at balancing the accumulated depreciation account. Now, we can see then that the credit side now totals 52,000. That's our accumulated depreciation to date. Because it's an SFP account, it rolls on year. So our balance carried forward for 2006 will be 52,000. And that would equal the credit side as a result. So then your opening balance to start 2007 with will be that 52,000. At that moment in time, the balance on your asset cost will still remain at 150,000. Nothing's changed. But the accumulated depreciation now at the year end would be 52,000. So if you take the cost debit balance of 150,000 and then minus the accumulated depreciation of 52,000, that's going to leave you with a carrying value in your 2006 SFP as 98,000 carrying value, which is what we said in our little working. So you can see there, 98,000. That's what would appear in the SFP. So you can all see the idea now. So you can do the other 3 years worth of transactions yourself. Okay, it's just posting the depreciation and getting a practice in for writing off the expense and then obviously carrying and bringing forward the accumulated depreciation. So that's how the ledger accounts work. And there we are, we've answered part 1 of this example. Full year's charge in the year of acquisition 2005. Now, the second requirement said that they want you to do straight line depreciation, but this time based on proportionate in the year of acquisition. Now think about it, we acquired the asset on the 31st of July 2005, yet our year end is the 31st of December. We've held our asset for August, September, October, November, December, 5 months. Okay, so don't be afraid to use your fingers if you need to count the months for proportionate. So when you start using your toes, that's when it gets a little bit funny in the exam. So, when we think about our depreciation charge then, it would still be 26,000 per annum straight line, but for the first year, because we've only held the asset for 5 months, well then surely we should only charge 5 months worth depreciation out of the full year's charge. So, in our second half of the page, I'm going to start with my asset cost, 31st of July 05. again with $150,000. Now, our depreciation then for our year end the 31st of December 05. Well, our depreciation per annum is $26,000, and that relates to 12 months, a year's worth of charge. We only want to show 5 months because this time it's proportionate depreciation. So I'm going to multiply that by 5/12. 5 months over 12. So the annual depreciation charge of $26,000 times 5/12 for a rounding is going to give us $10,833 as our depreciation for that year. Now the double entry would be the same: debit depreciation expense, credit accumulated depreciation. Now that's going to leave us with our carrying value at the 31st of December 05 to be the difference. So 139,167, again, just for a rounding. So that would be how proportionate depreciation works in the year of acquisition. Now all we've got to do is do this up until 2009. So at the 31st December 06, we've held that building for a full year, therefore a full year's worth of depreciation will be charged at $26,000, which is then going to give us our carrying value at the 31st of December 06 of 113,167. And we just continue on. All right, so let's carry on down. 31st of December 07, depreciation, 26,000. That's going to give us our carrying value, or our book value, of 87,167. And then December 2008, depreciation will, again, we've held that building for a full year, so 26,000, which is going to give us our carrying value of 61,167 at the 2008 year end. One more now. 31st of December 09, our depreciation minus 26,000 is going to give us 35,167 as our carrying value at the 31st of December 09. So essentially all you're doing is proratering the depreciation charge for the months of acquisition in its first year. Okay, in this case, we only held the asset for 5 months in 2005, and then for 06, 07, 08 and 09, we would have held that building for the entire year for each of those years. Now, I'm not going to do the double entry in the T accounts for that, because it would be precisely the same as what we did with the first example, but it would just be with a different figure in year 1. Okay, so that's straight line depreciation. Thank you.